Hi friends, so welcome to this video where we will be discussing Inter-CA RTP May 2022 for the subject of financial management. Children, have kept that RTP in front of you. Let's try to understand it. The first question, children, is from the chapter of ratio analysis. It is the missing figures question where they have given some data and they're asking you to find these 5 points. Let us go through this question. So they're saying FM Limited is in a competitive market where every company offers credit. To maintain the competition, FM Limited sold all its goods on credit and simultaneously received the goods on credit. So basically they're saying that this company sells goods on credit and even purchases on credit. The company provides the following information relating to the current financial year. So children, all this data is given. Then they are asking you to determine point number 1, sales and cost of goods sold. Now students, how to find sales and cost of goods sold? Very simple. If you can see, they have given to you the gross profit ratio as rupees 12 lakhs and they have also given to you the gross profit ratio as 25%, correct? Now children, you know the formula of gross profit ratio. It is nothing but GP upon sales into 100, correct? Gross profit upon sales into 100. And students, here, since we have the gross profit ratio, since we have the gross profit, we can easily find out sales. And once we find out sales, from that sales, if we subtract 25%, we will get COGS. Okay, so let me take you to the solution here. So what is, instead of saying point number 1, determination of sales and COGS. So students, as I told you, gross profit ratio is available, and children, since gross profit is given, we can easily solve this and get the sales as rupees 48 lakhs. Now children, from 48 lakhs, if you subtract 25%, or we can straight away subtract 12 lakhs, that is the gross profit, we will get COGS, right? So with that, we complete the discussion to the first point, that is sales and COGS. Next, students, they're asking us sundry debtors. Now, how am I supposed to calculate sundry debtors? First of all, do you realize that we have the data now that credit sales, okay, credit sales we have received is rupees 48 lakhs. And now they have given to us the debtors velocity. Now children, what is debtors velocity? Debtors velocity is nothing but average collection period. And children, you know the formula of average collection period. Average collection period is nothing but 12 divided by debtors turnover ratio. Everybody clear? 12 divided by debtors turnover ratio. So children, if the debtors velocity is 3, can I say we can easily find out the debtors turnover ratio? That's what institute has done here. You can see debtors velocity is 3 months, or the average collection period is 3 months. So using that data, children, they found out the debtors turnover ratio to be 4. Now children, what is debtors turnover ratio? Debtors turnover ratio is nothing but credit sales divided by average debtors, correct? Credit sales divided by average debtors, and these average debtors are of course including bills receivable. So now that you have the sales with you, you have the turnover ratio with you, we can easily find out the debtors including the bills receivable. So children, do you realize that if you do the calculation, debtors turnover ratio is equal to, okay, credit sales divided by average debtors including bills receivable, and therefore if we put the numbers, we will get the debtors plus bills receivable as rupees 12 lakh. Now children, in this 12 lakh, do you realize that bills receivable are 75,000, correct? Bills receivable included are 75,000. So the balance 11 lakh 25,000, do you realize, will be your debtors, correct? So with that, we complete the discussion to sundry debtors. Moving on to the third point, that is closing stock. Now students, how do you find closing stock? Very simple. They are telling you that the stock turnover ratio based on COGS is 1.5. Till here you understand? Now what is the formula of stock turnover ratio? Stock turnover ratio is COGS upon average stock, correct? COGS upon average stock. Now you have the stock turnover with you, you have the COGS with you. We can easily find out the average stock, correct? We can easily find out the average stock as rupees 24 lakh, correct? Average stock comes to rupees 24 lakh. COGS we had already calculated some time back, and the stock turnover ratio was given to you. We find out the average stock as 24 lakh, but they are not asking you average stock, they are asking you closing stock. So how to find out closing stock? Now read this line. FM Limited has the tendency of maintaining extra stock of 30,000 at the end of the period than at the beginning. So which means they are saying that if opening stock, okay, is X, closing stock, okay, closing stock, children, do you realize closing stock will be X plus 30,000? Everyone clear? X plus 30,000, because they are saying they have a tendency of maintaining extra stock of 30 at the end of the period as compared to the beginning. So if the beginning, that is the opening stock, is X, closing stock will be X plus 30,000. Now children, we already have the average stock as rupees 24 lakh. Now what is average stock? Can I say average stock is nothing but opening stock plus closing stock divided by 2. Everybody clear? Opening plus closing divided by 2. Average stock we already have as rupees 24 lakh. So we write down here 24 lakh, and if you solve this, children, we can easily get the opening stock as well as the closing stock. Children, that same calculation they have done here, and they have got the opening stock as 23 lakh 85,000, and then on this opening stock of 23 lakh 85,000, if we add 30,000, we will get the closing stock as 24 lakh 15,000. That, children, is the answer to your point number 3, calculation of closing stock. Then children, moving on to our next point, that is sundry creditors. But students, to calculate sundry creditors, you will have to first of all find the credit purchases, correct? Now how do you find credit purchases? Children, do you realize that COGS is equal to opening stock plus purchases, and they have told you very clearly in this question that all purchases are credit purchase only, minus closing stock. Now some time back we have already calculated the COGS, we have already calculated the opening stock, we have already calculated the closing stock. We can easily find purchases as the balancing figure as they have done here. You can see COGS is equal to opening stock plus purchases minus closing stock. If you calculate, children, you will get the purchases as rupees 36 lakh 30,000. So 36 lakh 30,000 become your purchases. I'll write down here, purchases are 36 lakh 30,000. Now from purchases, how do I find creditors? Same way in which you found debtors using sales. Everybody clear? Just as you found debtors using sales, children, this velocity of debtors was given. Similarly, velocity of creditors is also given. So if I just share with you, I can tell you that creditors velocity, okay, creditors velocity means nothing but average payment period. Can I say average payment period? That is 2 months here. Okay, average payment period is nothing but 12 divided by creditors turnover ratio, correct? 12 divided by creditors turnover ratio. That will give you the creditors turnover ratio as 6 times, correct? Creditors turnover ratio as 6 times. Now what is the formula of creditors turnover ratio? Creditors turnover ratio is nothing but credit purchases divided by average creditors. Everyone clear? Credit purchases divided by average creditors, including bills payable, okay, including bills payable. So students, we know something, that we already have the creditors turnover as 6 times, correct? We already have the creditors turnover as 6 times. We already have the purchases as 36 lakh 30,000. We have calculated it, 36 lakh 30,000. Students, do you realize we can solve this and get the average creditors, but that will be including the bills payable. From that total answer that we get, if we subtract the bills payable of 30,000, we will be able to get the sundry creditors. I'll show the solution to you. Okay, so here you can see the creditors turnover ratio, as we had also got, is 6 times. So children, credit purchases upon average creditors including bills payable is equal to 6. So we get the total creditors as 6 6,05,000 including bills payable. From that 6,05,000, if I remove 30,000, what I get is the sundry creditors of 5,75,000. So with that, students, we complete point number 4. And now point number 5, fixed assets. Children, for fixed assets it is very simple. They are saying fixed asset turnover ratio. Now generally turnover ratio is based on sales, right? Fixed assets turnover ratio is based on sales, but here very clearly they are saying that it is to be calculated on COGS, which means, students, do you realize COGS divided by average fixed assets is equal to 4, correct? COGS upon average fixed assets is the formula for fixed assets turnover ratio if it is based on COGS. Children, COGS we already have, 4 is there. We can easily find out fixed assets. Everybody clear? COGS upon fixed assets is equal to 4. COGS we already have 36 lakhs. 4 is there. We get the fixed assets as rupees 9 lakh. So with that, children, we complete the discussion to the first question of your RTP that was based on the chapter of ratio analysis. Let us now move on to the second question, which is based on the chapter of cost of capital. Let's start. Now this question on cost of capital, children, is based on the calculation of WACC, both on book value as well as market value weights. Let us study this. So they are saying the information relating to book values and market value weights of X Limited are given below. So children, they have given to you equity, retained earnings, preference shares and debentures. Do you realize for equity you will require KE, for retained earnings you will require KR, for preference shares you will require KP, for debentures you will require KD. Moving on, additional information. Now children, these points 1 and 2 are given to you to help you calculate KE. Let's see how. So they're saying equity shares are currently having a market price of 130. So this is your P0. And the new issue price will be at rupees 125 per share fully subscribed. So can I say that this is your issue price? And the flotation cost will be rupees 5 per share on face value. So children, do you realize that from issue price, if I subtract the flotation cost of 5 rupees, what I get will be net proceeds. Now students, here I would like to tell you one very important point. This is how ICAI does it. Children, if they are having, correct, a new issue, then of course when you calculate the KE using the Gordon's formula, it will be D1 upon not P0 but net proceeds into 100 plus growth rate, where the net proceeds is nothing but the issue price minus the flotation cost. But then what ICAI says is that this KE that you get, you cannot then assume that KE to be KR, because children, for the reserves, the cost of the reserves should not include flotation cost, right? Flotation cost should be there only for the purpose of calculating the cost of the new equity. And therefore, when you are calculating KR, please do not take this answer as the KR. You will have to recalculate the KR using the Gordon's formula itself, where instead of NP, you will take the entire P0, that is rupees 130. Everybody, are you all able to understand the original share price which was there? We will not take net proceeds. Everyone clear? So that is the discussion that is there in this particular question. So let's now move ahead, children. Then they are saying during the previous year or the previous 5 years, dividends have steadily increased from 10 to 16.105 per share. Now students, this is a hint that you have to calculate the growth rate, right? If the dividends have grown from 10 to 16.105, what must be the compounded growth rate? Children, very simple calculation. See, you know the formula FV is equal to PV into 1 plus R raised to N. So if 10 has grown to 16.105 in a matter of 5 years, how much is the growth rate? How much is the R? How much is the compounded interest? We call it as interest, but basically what we are calculating is the growth rate. If you solve this, children, you will get the growth rate as 10% per annum. So we got the G, we have the net proceeds, and they're saying dividends at the end of the current year are expected to be 17.716 per year. Children, this, can I say, will be your D1, correct? So we have the D1, we have the net proceeds, we have the growth rate. Let us understand the calculation of KE. So children, question number 2, cost of equity will be D1 upon net proceeds plus the growth rate, which has been calculated here using the same calculation I showed you. And if you do the calculation, you will get KE as 0.2476, that is nothing but 24.76%. But that same calculation when we are doing for KR, I will take everything same, D1 same, growth rate same, but in the denominator, instead of net proceeds, I'll take the original P0, right? And that, children, will give you KR as 23.63%. Moving on, children, to calculate KP, they're saying 15% is the preference dividend rate, face value is 100, but its current market price is 105. Children, this is a very simple irredeemable preference share. So the calculation will be preference dividend divided by market price into 100. Since the face value is 100, the preference dividend will be rupees 15. 15 upon 105 into 100 will give you the KP calculation, that is 14.29%, correct? 14.29%. Next, students, comes the calculation of KD. So they are saying the company proposes to issue 11-year 15% debentures, but the yield on debentures on similar maturity and risk class is 16%. Flotation cost is 2% on face value. Now I'll tell you what is happening here. Students, if I assume that this particular debentures face value is rupees 100, do you realize the interest, the coupon rate being 15% will be 15, correct? But then investors are saying, hey, you know what, we receive 16% outside if we invest, we will get a 16% return. So children, therefore, in order to make this 15 rupees coupon attractive to these investors, do you realize the issue price of this debenture should be 15 divided by 16%? And if you divide 15 by 16%, students, what you get is 93.75, correct? 93.75. What is the logic of 93.75? Let us understand reverse. We are asking investors to invest 93.75 in this debenture and will give them a 15 rupees per annum coupon. Students, on the 93.75 rupees investment, if the investors get a 15 rupees coupon every year, that amounts to a 16% return for them, that is 15 upon 93.75 into 100. So now the calculation that we have done is we are saying, okay, we will offer 15 rupees as the coupon. If you want that this 15 should feel like a 16% return, don't invest face value, we will giving it to you at discount at 93.75. So the issue price, therefore, children, becomes 93.75, from which, children, 2% on face value, that is 2% of 100, that is 2 rupees, will be flotation cost. So 93.75, okay, 93.75 minus 2 rupees, 91.75 will become your issue price. Everyone clear? So now, children, let's go to the KD calculation. So if you do the KD calculation here, you know the formula of a redeemable KD. So students, how did you know it is a redeemable KD? Because the life was given to you as 11 years, correct? So students, 15 rupees is the interest into 1 minus T, correct? 15 into 1 minus 0.3 plus RV assumed to be at par minus issue price we just now discussed divided by 11, the whole upon RV plus issue price divided by 2 into 100 will give you 0.1173 as the KD, that is nothing but 11.73%. So with that, children, we now have the KE, the KR, the KP and the KD. What are they asking? You are required to determine the WACC of this company using both the weights. So first of all, children, let's talk about the book value weights. Students, if I am calculating WACC using book value weights, these amounts are given to you in the question itself. I'll show it to you. Correct? These amounts are given to you: 240, 60, 72 and 18. 240, 60, 72 and 18. These are given to you. The costs we have calculated. Here, institute has done the WACC in this fashion: book value into cost, book value into cost. Doing like this, they have got the total here, and this total divided by 390, correct, will give you the WACC. Other way that you must have been taught in the class is where we calculate the weights of these book values, correct? We calculate the weights, And then these weights, when we multiply by the costs, we get weights into cost. The total comes as the WACC, which of course exactly will come as 22.05. This is just another mathematical way of doing it. Everyone clear? Then children, they are also asking you to calculate based on market value weights. Now, according to institute, this is a very, very peculiar point. Generally, when we calculate WACC based on market value weights, we are supposed to ignore reserves, because reserves, the market value of reserves is deemed to be included in the market value of the equity shares. Therefore, we never show reserves market value separately. But in this question, because KE and KR are different, please listen to me carefully. Because KE and KR are different, they are separate. Therefore, institute is saying you cannot ignore the reserves even while doing market value weights. Now children, this question is there in your study module also. In RTP, there's not a new question in RTP, right? It's there in your study module also. There also ICAI has followed this only, where they are saying that if the KR and KE are differently calculated, they have got different values, then you cannot ignore reserves when you are doing the market value weights. Everyone clear? So children, here if you see, the market value of equity is 4 crores, correct? The market value of equity is 4 crores, but this 4 crores, can I say, includes the equity as well as reserves part. So what ICAI says, you bifurcate this into two parts, okay? You bifurcate this into two parts, market value of equity and market value of reserves. Everyone clear? Market value of equity and market value of reserves in what ratio? In the ratio of their book values. Everybody clear? In the ratio of their book values, that is children 240:60, or you might say 4:1. Everybody clear? Bifurcated in the ratio of 4:1. So children, that's what they have done. They have bifurcated the market value of equity in the ratio of 4:1. That is the book value of equity and reserves. In the ratio of book value of equity and reserves, the market value of equity has been bifurcated. So basically 4 crores into 4 by 5, okay? 4 crores into 4 by 5 will be the market value of equity, and 4 crores into 1 by 5 will be the market value of reserves. The other two market values, children, are given to you in the question. And then children, costs, of course you have. You now know how to calculate WACC, right? Either do it the way institute did it here, or do it the way in which you must have been taught in your classes, where the weights were calculated and then we do cost into weights. You will get this WACC. Everybody clear? So with that, children, we complete the discussion to calculation of WACC for this question. That is the second question of RTP based on the chapter of cost of capital. We then move on to the third question, which is based on capital structure. Let's start. So this question, children, is based on the concept of capital structure theories. You remember net income approach, net operating income approach, theory, all that is there here. Let us now try to understand. Capital structure question number 3. The following data relates to two companies belonging to the same risk class. So B Limited and C Limited are given. Both of them have the same EBIT, that is NOI, net operating income. But one has debt, the other doesn't. Children, this is the equity capitalization rate of C Limited, that is KE. You are required to, point number A, determine the total market value, that is value of the firm, equity capitalization rate, that is KE, and weighted average cost of capital for each company, that is WACC, assuming no taxes as per approach. Now children, institute has given one solution. I would like to give you my own solution. Of course the answers will tally, but then you can see mine, you can see institute solution, whichever you are comfortable, you can go ahead with that. Of course, all answers are telling, okay? Nothing to worry there. Now children, when they say that as per approach and no taxes, please listen carefully. When there are no taxes and as per approach, they are asking you to find all these things. Then children, approach becomes same as net operating income approach. Everybody clear? In approach, if no tax is taken into consideration, it is same as the net operating income approach. So I would like to solve this particular question by the NOI model. Please pay attention here. See, so I'll write down here point number 1, no tax, okay? No tax. Ready? So I'll write down here particulars and then the two companies are B and C. So I'll write down here B and C. Now according to the NOI approach, children, we start with NOI, that is the net operating income, that is 9 lakhs and 9 lakhs given to you. So I'll write down here 9 lakhs and 9 lakhs. Okay. Now students, this NOI, when we capitalize it at the rate KO, right, when we divide it by KO, what we get is the value of the firm. Now children, where is KO in the question? As far as C Limited is concerned, students, do you realize that they have given to you KE? Now if in C Limited there is no debt, can I say KE and KO will be same? KO means overall cost, WACC, correct? If there is no debt, cost of equity and overall cost will be same. So for C Limited, I know I have to take 18%. Secondly, children, do you realize in approach without tax, and therefore in NOI approach, the values of both companies and their KO are same. Everyone clear? In NOI approach and without tax approach, the KO of both companies, the value of the firm of both companies, of course under the understanding that both have the same NOI, will be same, and therefore I will take KO here also as 18%. So children, if I take my calculator and I do 9 lakhs, okay, 9 lakhs divided by 18%, I get 50 lakhs. Okay, so 50 lakhs, children, therefore becomes the value of the firm for both the companies, right? Now from this value of firm, if I subtract value of debt, I will get value of equity. As far as C Limited is concerned, there is no value of debt. As far as B Limited is concerned, the value of debt is 27 lakhs. So children, when we subtract this value of debt, we get the value of equity as 23 lakhs and here as 50 lakhs. Everybody clear? 23 lakhs and 50 lakhs. Then children, I would like to write down the interest. Now interest, do you realize in C Limited will be nothing since there is no debt. As far as B Limited is concerned, children, the interest, can I say, will be 27 lakh into 12%, correct? So 27 lakh into 12% if I do, okay, 27 into 12% will give me 3,24,000. So I'll write down here 3,24,000 is the interest. Children, can I say NOI minus interest will give me net income, NI, that is the income of equity shareholders, that is nothing but the dividends for equity shareholders. So the NI, children, okay, the NI will therefore come to, right, 9 lakhs minus 3,24,000, this is 5,76,000. And as far as C Limited is concerned, children, that NOI and NI will remain same. Now I'll calculate KE. What is the formula of KE? It is NI upon value of equity into 100. So students, 5,76,000 is the NI divided by 23 lakhs. So if I divide this by 23 lakhs, I get 25.04% as the KE for B Limited. And as far as C Limited is concerned, children, 9 lakh upon 5 lakh, the KE and the KO, as you know, are same. So with that, children, we calculate the value of firm done, KE done. The only thing left is WACC. Now this is actually time pass because WACC is nothing but KO, we already have it. We have to simply recalculate it using the weighted average cost of capital table. Now as far as C Limited is concerned, children, there is nothing to prove here because since KE and KO are same, WACC also will be same, only that is 18%, right? Because there is no debt. What you need to show and prove here, or what I need to teach it to you, is how to calculate WACC for B Limited. For C Limited, it is absolutely nothing to calculate since there is no debt only there. So I'll write down here calculation of WACC for B Limited. Okay, the table I would like to make: source, amount, cost, weights, right, and cost into weights. So we have got value of equity, we have got value of debt, and the total is value of firm. Value of equity, you can see here, is 23 lakhs. Value of debt, as you know, is 27 lakh, and the total is 50 lakhs. As far as costs are concerned, we got the KE as 25.04%. We have the KD as 12%. There is no tax, so straight away interest rate only I am taking as the KD. And now children, let's calculate the weights. 23 divided by 50, this is 0.46, and therefore this will be 0.54. Children, now let's calculate the WACC. Okay, let us calculate the WACC. So 25.04 multiplied by 0.46, this is 11.5184, and then we have got 12 into 0.54, this is 6.48. Children, this 11.5184 can be rounded off to 11.52, correct? 11.52. And then students, if you take the total, it of course totals to 18%. So with that, children, we complete the discussion to your point number A, where we calculated all these things for both companies. I'll show you institute solution also, children. Here, if you can see, total value of the firm, as you can see, for both the firms is coming to 50 lakhs itself. And then children, as you proceed further, you can see that they have got for B Limited the KE as 25.04. We had also got KE as 25.04. Value of firm was 50 lakhs. Everything same. We had got value of equity as 23 lakhs. They have also got the value of equity as 23 lakhs. And then they did the same WACC calculation, with which we got 18%. Everyone clear? Same to same calculations. Everyone done? So with that, we complete the discussion of point number A. Now students, let us go on to point number B. Now children, in point number B, let's see what they are saying. Everything is same, it is just that they are now taking into consideration tax. So they are saying determine the value of firm, determine the KE, determine the WACC using approach for each company, but with a 40% tax. So students, when I write down here point number 2, I should tell you that when it is with tax, then what does say? They say that value of the unlevered firm, unlevered means the firm in which there is no debt, should be EBIT bracket 1 minus T upon KO. Everyone clear? EBIT bracket 1 minus T upon KO. Now here the unlevered firm is which company? B or C? Correct, C is the unlevered company. So can I say value of C will be equal to EBIT. Now EBIT, children, here is 9 lakhs. So I'll write down here 9 lakhs. Tax rate is 40%, and students, KE and KO for C Limited will be same, that is 18%. So I'll write down here 18%. So we get the value of C Limited as 9 lakhs, correct, minus 40%, correct, divided by 18. We get the value of C Limited as rupees 30 lakhs. Everyone clear? And then children, as far as value of the levered firm is concerned, says it is value of unlevered plus debt, okay, into the tax rate, correct, plus debt into tax rate. Value of unlevered, children, is 30 lakhs, debt is 27 lakhs, and tax rate is 40%. So students, this is 30 lakh plus 27 lakh into 40% is 10.8 lakhs, and this therefore comes to 40 lakh 80,000. So with that, children, we calculated the value of firms of both the companies. One is having a value of 30 lakhs, the other is having a value of 40 lakh 80,000. Next, what they are asking, value of firm done. Then they are asking us to calculate KE. Now children, in order to calculate KE, do you realize I did not calculate anything for C Limited because KE is already given to you. KE, KO, everything will be 18% only. But as far as B Limited is concerned, we will have to calculate KE, right? So I'll just show it to you here. For B Limited, okay, for B Limited, first of all, children, what is the formula of KE? KE will be NI divided by value of equity into 100. Now, as far as value of equity for B Limited is concerned, can I say it is nothing but the value of firm minus value of debt? Correct? Value of firm minus value of debt. Value of firm we already have 40 lakh 80,000. So I'll write down here 40 lakh 80,000, and value of debt, children, as you know, is 27 lakh. So 40 lakh 80,000 minus 27 lakh, we get the value of equity as 13 lakh 80,000. Moving on to NI, children, moving on to NI. How to calculate NI? NOI of B Limited, as you know, is 9 lakhs minus interest. If you remember, the interest here okay, is 3,24,000. Children, please note, you cannot take this NI because your tax was not taken into consideration. Now the tax is to be taken into consideration, we'll have to make that income statement. The interest here is 3,24,000. So I'll write down here 3,24,000, and that will, children, give me EBT. Everybody clear? It will give me EBT as 5,76,000 minus tax at the rate 40%. Okay, so 5,76,000 into 40% will give me 2,30,400, and if I subtract that, I will get NPAT, that is nothing but NI. So 576 minus 230,400, okay, will give us NI as 3,45,600. okay, 3,45,600. So now that we have the NI, let us calculate KE. Children, the KE will be 345,600 divided by 13,80,000, both of which we just now calculated, into 100. Okay, we get the KE as 3,45,600 divided by 13,80,000. okay, we get the KE as 25.04%. Everybody clear? KE is 25.04%. So with that, children, we complete the calculation of KE for both the companies. Then they're asking WACC. Again, let me repeat, nothing to calculate for C Limited since its WACC is 18 only. What we need to do is for B. So children, for WACC, can I say we already have the KE as 25.04%. Now as far as KD is concerned, if there was no tax, then KD would have been equal to interest rate. But since there is tax, KD will be equal to interest rate into 1 minus T. Everybody, you are able to understand? And the interest rate, children, is 12%, tax rate is 40%, and this will give you a KD of 7.2%. Now that we have the KE and KD, let us calculate WACC. So we have got source, amount, cost, weights, cost into weights. In source, we have got value of equity, we have got value of debt, and we have got value of firm. As far as value of equity is concerned, we have got it as rupees 1380, correct? 13,80,000. Debt is 27 lakh, and the total value of firm is 40,80,000. As far as costs are concerned, 25.04% is KE, 7.2% is KD. Let's calculate the weights. Okay, so 13,80,000 divided by 40,80,000 will give you a weight as 0.34. okay, 0.34, and this will be, children, 0.66. Everybody clear? 0.66. So children, now that we have the weights, let us calculate the WACC. 25.04 into 0.34, this is 8.51, and then students, 7.2, okay, 7.2 into 0.66, this is 4.75. If we take the total, 8.51 plus 4.75, this will give you a WACC of 13.26% for B Limited. Children, that WACC, that is nothing but KO. has given one more formula. If you don't want to do it from WACC method, of course, here in this question very specifically they had told you use WACC, but overall cost of capital, if you wanted to find, we could have very well done like this: EBIT bracket 1 minus T upon value of firm into 100, correct? EBIT bracket 1 minus T upon value of firm into 100. That's another shortcut way to get that same 13.26. EBIT is 9 lakhs. Tax rate is 40%, okay, and value of firm, children, is 40,80,000. If you do the calculation, students, 9 lakhs into 60% or minus 40% divided by 40,80,000 into 100, you will get 13.24%. Children, this is just a rounding of difference because we have rounded off a lot of stuff here. Everyone clear? Otherwise the answers are same. So children, let us now go to institute solution. Okay, institute solution. Let us check if taxes are assumed. What are they getting? 30 lakh is for the unlevered, 40,80,000 for the levered. Both these answers we had got. Then students, as far as C is concerned, there is no question of solving anything because KE, KO, everything is same. As far as B is concerned, children, If you remember, we had got the KE as 25.04% here, right? Which was 345,600 upon 13,80,000. Correct? 345,600 upon 13,80, 25.04. And then students, when they do the WACC calculation, I hope you understand that they also end up at 13.23%. Everyone clear? We had also got that 13.23%. This was 13.23 something. We rounded it off to 13.24. This also is a highly rounded off figure. Point being, everything else is exactly same. Everyone clear? 25.04 is your KE and 7.2%, as I showed it to you, 7.2% will be your KD. So with that, children, we complete the discussion to this question, that is question number 3 of capital structure based on approach. Now students, let us now go to the next question, which is based on a very interesting chapter called as leverages. Let us now try to understand this. Now this question of leverages is again based on this concept of missing figures, where some data is given and you have to make that income statement from sales to NPAT. Find the missing figures. But in this question, there is a concept, or there is an application of a concept called as margin of safety, which was introduced by the CA Institute in your study module recently. And I would want you all to first of all understand the concept of margin of safety. Only then we can understand this question. So what I will do is, I have my online product, right? The entire financial management of CA Inter, all chapters, all videos I have already recorded, and they are up for sale on our website online.jkshaclasses.com, where if you visit, you can purchase my entire content of financial management, either the entire subject, or even if you want a single chapter is also available for sale. So students, from that video library of mine, I'll be pulling out one video and I'll be sharing it right here in this video concerning the concept of margin of safety. I would want all of you to understand that video, go through the entire explanation, and then we'll come back and we'll continue this question. Please start. It's a small concept called as margin of safety. Children, actually this concept is from the subject of costing, but because it has a small implication here in this chapter of leverages, I'll just give you a brief idea of what margin of safety is and then its implication on the leverages part. Once we understand this, then in the next video, we will be solving one question which is there in your study module based on this concept of margin of safety. Can we start? So first of all, children, what I will do is, I'll just make an income statement for you only from sales to EBIT, okay? So I'll write down here particulars, okay? I'll write down here particulars and amount, okay? Particulars and amount. As far as the income statement is concerned, we know sales minus variable cost. Children, let's say variable cost is 75% of sales, okay? So we will get contribution, correct? We'll get contribution minus fixed cost will give you EBIT. Let me put the numbers, children. Let's say sales are rupees 1 lakh. That will give you variable cost of 75,000. Everybody clear? 75% of 1 lakh. That will give you a contribution of rupees 25,000. Let's say, children, fixed cost is rupees 20,000, and that will give you EBIT of rupees 5,000. Till here everybody is clear. Now I'm just giving you one more case. This is the case of a break-even point. Now children, what is the meaning of break-even point? Break-even point refers to that level of sales at which this profit is zero. Everybody clear? It refers to that level of sales at which profit or your EBIT is zero. So children, let's try to search that. We'll go upstairs, okay? Reverse will go. So we want EBIT to be zero. Fixed cost, of course, will remain fixed at 20,000. So children, at a fixed cost of 20,000, if you want EBIT to be zero, do you realize your contribution should be rupees 20,000? Everybody clear till here? We're going upstairs, right? Reverse we are going. So children, let me repeat again. For EBIT of zero, Considering that fixed cost is 20,000, do you realize contribution has to again be 20,000? Now how do I go upstairs? We know, okay, we know that if sales are rupees 100, do you realize variable cost will be 75 and therefore contribution will be 25. Everybody follow until here? If you do the cross multiplication, okay, you will get the sales as rupees 80,000 and you will get the variable cost 75% of 80,000 as rupees 60,000. So what is this 80,000? Children, I will say that break even point here is rupees 80,000 because it is at this level of sales that the profit is zero. No profit, no loss situation. So children, break even point is that level of sales at which there is no profit, no loss situation. So now let us proceed ahead, children. Here there is in the subject of costing one formula or one terminology called as margin of safety percentage. Okay, very simple this is. I'll first of all tell you what the formula is. It is sales minus break even point divided by sales into 100. So let's put the numbers, you'll understand. What are my actual sales, children? Can I say my actual sales are rupees 1 lakh and my break even point is rupees 80,000. So can I say 1 lakh minus 80,000 divided by 1 lakh, okay, into 100. If we do, we'll get 20,000 divided by 1 lakh into 100, that is 20%. What is this 20%? I am saying that currently my sales are rupees 1 lakh. The break even point is rupees 80,000. If my sales go below 80,000, can I say losses will start? At 80,000 level of sales, can I say there is no profit, no loss? Above 80,000 level of sales, can I say profit starts? Right now I'm sitting at a sale which is above 80,000 at rupees 1 lakh. Can I say higher I am above 80,000, the more safe I will feel? Everybody clear? Because children, below 80,000 losses will start. Everybody clear? At 80,000 there is no profit, no loss. The higher I am above 80,000 in terms of sales, the more safe I will feel, and therefore I am saying that considering that my current sale is rupees 1 lakh, I have a 20% safety margin. Everybody clear? Because 20,000, if it drops from the current level of sales, I will encounter a no profit, no loss situation, and below that there will be losses. So did you all understand margin of safety formula as well as the calculation as well as the interpretation and meaning here? Great. Now children, let us now connect this to our leverages chapter. Okay, see children, I'll again write down here margin of safety percent. Yes, margin of safety percent. What is the formula? It is sales minus break even point divided by sales into 100. And into 100 you leave it for some time. Children, what if I multiply and divide by PV ratio? Okay, what if I multiply and divide by PV ratio? Now many of you must have not heard about a PV ratio. Children, PV ratio I will write down here for you. Okay, PV ratio refers to profit volume ratio and the formula is contribution upon sales into 100. Okay, contribution upon sales into 100. In this particular example, if you see, in this example children, do you realize that if the variable cost is 75%, contribution will be 25% of sales? Everyone clear? If sales are 100, variable cost is 75, so contribution, children, can I say will always be 25% of sales, and that is exactly what is the PV ratio. Children, here can I say in this example your PV ratio is 25%, right? 25% of sales. Contribution is 25% of sales. Everybody clear till here? Now children, moving ahead with this particular equation, do you realize that if this PV divided by PV is to be multiplied by this existing equation, can I say it will be sales into PV minus break even point into PV, the whole divided by sales into PV. Everybody clear? Now sales into PV, children, sales are rupees 1 lakh. Okay, sales here are rupees 1 lakh. If I multiply by the PV ratio 25%, do you realize I will get the contribution? Everybody clear? So sales into PV ratio is the contribution. So I'll write down here, instead of sales into PV, I will write down contribution. Okay, I'll write down here contribution minus Children, break-even point into PV ratio. Now, what is the break-even point here? Can I say break-even point is 80,000? If I do 80,000 and I multiply this by 25% PV ratio, do you realize, children, what I will get is the fixed cost? Everyone understanding? Break-even point into PV ratio will always give you the fixed cost, that is 20,000. Everyone clear till here, right? So therefore, children, I will go downstairs here again, okay? And I will write down break-even point into PV ratio is nothing but fixed cost, the whole divided by, and as you know, sales into PV ratio is again contribution, right? Sales into PV ratio is contribution. So children, margin of safety formula can therefore be rewritten like this. I am pretty sure you understand, if I multiply and divide by PV ratio, the formula should not change, right? Because it is multiplying and dividing by the same number. So therefore, children, your margin of safety can be rewritten as contribution minus fixed cost upon contribution. Children, can I say margin of safety will be contribution minus fixed cost? You all know is EBIT, and below, children, we have got the contribution. Everybody clear till here? Yes. So MOS is equal to EBIT upon contribution. Now children, of course, if you multiply by 100, you will get this MOS as a percentage. If you don't want the MOS as a percentage, you want it as 0.2 or 0.3, whatever, you know, in 0 point something, then you need not write this into 100 here. Everybody got it till here, right? Now children, I hope you understand that operating leverage formula was contribution upon EBIT, right? Operating leverage was contribution upon EBIT. MOS is EBIT upon contribution. Can I say therefore your operating leverage will be the reciprocal of margin of safety? Everybody clear? Your operating leverage will be reciprocal of margin of safety, because if we take a reciprocal of this, do you realize what we get is the operating leverage? So the end conclusion of this entire video, the entire discussion is this formula. I hope you understood it. It is there in your study module also. I will show that to you also. Children, can you see here? Degree of operating leverage is 1 upon margin of safety. That is exactly what we are saying. Operating leverage is 1 upon margin of safety. Everybody got it till here? So children, with that we complete the discussion of this particular point, that is the theory part of margin of safety and its connection with our leverages chapter. I hope you understood this discussion. Okay students, so how was it? I hope you understood the concept of margin of safety. And now that you have understood it, let's now try understanding this RTP question, question number 4. Company P and Q are having same EBT. However, the margin of safety of company P is 0.20 and company Q is 1.25 times that of company P. So children, if I write down question 4, as far as margin of safety is concerned, for P it is 0.20 and for Q it is 0.20 into 1.25, that is 0.25. Everyone clear? So now that we have the margins of safety with us, you know that operating leverage is nothing but 1 upon margin of safety. So students, can I say for P the operating leverage will be 1 upon 0.2, that is 5 times, and for Q it will be 1 upon 0.25, that is 4 times. Everyone clear? So we got the operating leverage for both the companies. Moving on, the interest expense of company P is 1,50,000. So I'll write down here interest for company P is 1,50,000, correct? 1,50,000, and that for company Q it is 1/3 less than that of company P. So it is 1,50,000, 1/3 less. So it is 1,50,000 into 1/3, which is equal to rupees 1 lakh. Everyone understood interest? Then children, we move on. They are saying the financial leverage of company P is 4. So financial leverage of company P is 4 and that of Q is 75% of P. Okay, that of Q is 75% of P. So Q will be 4 into 75%, that is 3. So with that children, we have got the operating leverage for both companies, interest for both companies, financial leverage for both companies. Let's see if we can make any income statement here. Students, here other information is given. We'll take it up in some time. You are required to prepare income statement. So I'll write down here income statement. Okay, income statement. Now children, in income statement we have got particulars, then we have got these two companies P and Q. Okay, P and Q. Students, let's start income statement. Sales minus variable cost will give contribution, minus fixed cost will give EBIT, minus interest will give EBT, okay, minus tax will give NPAT. Now as far as tax is concerned, they have given it to you in the question. Tax rate is 45%. So I'll write down here tax rate at the rate 45%, okay, will give NPAT. Now children, let's see what all data is available. Interest we already have, right? We have the interest as 1,50,000 for P and 1,00,000 for Q. We had just now calculated it. Students, if we have interest, if we have financial leverage, we can easily find out EBIT, EBT. I'll show it to you how. See, students, financial leverage. Children, first of all, do it for company P. Okay. FL formula is what? It is EBIT upon EBT. Correct? FL is EBIT upon EBT. Can I say FL can also be written as EBIT upon EBIT minus interest, correct? EBIT upon EBIT minus interest, because EBT is nothing but EBIT minus interest. For P, the FL is 4 times, correct? So we will write down 4 is equal to EBIT upon EBIT minus 1,50,000. Everyone clear? That is the interest. So children, 4 EBIT minus 6 lakhs, correct, will give you EBIT. And students, therefore 3 EBIT will be equal to 6 lakhs, and therefore EBIT will be equal to 2 lakhs. Everybody clear? So with that we get the EBIT for company P as 2 lakhs, EBT will become 50,000, tax rate 45%, so we will do 50,000 multiplied by 45%. This is 22,500, and then children, 50,000 minus 22,500, you will get 27,500 as the NPAT. Let's now replicate the calculation for Q. So for Q, children, do you realize the FL for Q was 3 times? Okay, so I'll straight away start here that 3 is equal to EBIT upon EBIT minus 1 lakh, correct? 3 is equal to EBIT upon EBIT minus 1 lakh. So 3 EBIT minus 3 lakhs is equal to EBIT. Everyone, you are able to understand? So therefore 2 EBIT is equal to 3 lakhs, and therefore EBIT comes to 1.5 lakhs. Everyone clear? And that, children, I'll place it here, 1.5 lakhs. You get the EBT as 50. In fact, they are told in the question at the start only that both companies are having same EBT. You could have taken this data also and solved it. So children, 50,000 into 45% of course is 22,500, and this is 27,500. Everybody clear? Now children, how to go upstairs? We have the operating leverage with us. Everybody clear? We have the OL with us. Let me show you the calculations here only. Okay, now for P, okay, for P Limited, children, first of all, what is the formula of OL? OL is equal to contribution upon EBIT. The operating leverage for P is 5 times. So can I say 5 is equal to contribution? Okay, 5 is equal to contribution divided by EBIT of P, that is 2 lakhs. So I'll take 2 lakhs here, and I get the contribution as rupees 10 lakhs. Everybody clear? I get the contribution as rupees 10 lakhs. We put 10 lakhs here, and we understand the fixed costs to be rupees 8 lakhs. Similarly for Q, children, for Q the operating leverage was 4 times. So can I say 4? Okay, for Q, 4 is equal to contribution upon EBIT, and for Q the EBIT was 1,50,000. So I'll write down here 1,50,000, and therefore we get the contribution as rupees 6 lakhs. Everybody clear? We get contribution as rupees 6 lakhs. Children, will take that 6 lakh contribution here, and we understand fixed cost to be a balancing figure as 4,50,000. So with that we have completed till contribution. Now how to go upstairs from here? For that they have given to you the PV ratio. You have studied this in costing, right? PV ratio is nothing but contribution upon sales into 100, right? Contribution upon sales into 100. For P, if PV ratio is 25, it means that if sales are 100, contribution is 25, variable cost is 75. Let us do the cross multiplication. So children, this is 10 lakhs divided by 25 into 100. Okay, this will give us 40 lakh as the sales, and of course 30 lakh as variable cost. Now as far as Q is concerned, okay, they are saying it is 33.33%. so students, that means if sales are 100, contribution is 33.33, and therefore variable cost must be 66.67. let's take the calculator and solve this. 6 lakhs divided by 33.33 into 100, if we do, we get 18 lakhs. Okay, we get 18 lakhs as the sales, and therefore 12 lakhs as the variable cost. Everybody clear? 12 lakh as the variable cost. With that we complete the income statement. Let me take you to institute's solution. Question 4, you can see 40 lakhs and 18 lakhs. 40 lakhs, 18 lakhs. We end at 27,500, 27,500, and then everything else in between is of course the same. Everyone clear? So with that we complete the discussion to question 4, that was on leverages. Let us now go to question number 5, that is on investment decisions, that is capital budgeting. Now this question from capital budgeting is based on a concept called as the replacement cycle. Now what that is, I'll explain to you in depth through this particular question. Let's start. They are saying ABC and company is considering whether to replace an existing machine or to spend money on revamping it. So basically this company ABC has an existing machine already. They are thinking, should we replace it with a new one, or should we spend money on it to revamp it, or basically to improve it, right? This company currently pays no taxes. Great. The replacement machine costs 18 lakh now. So they are saying that this machine, the replacement machine, the new machine has a cost of rupees 18 lakhs. It requires maintenance of 2 lakh at the end of every year for 8 years, which means the life of the new machine is 8 years, and for every year you have to incur 2 lakh rupees for the maintenance of that new machine. At the end of the 8th year, it would have a salvage of 4 lakhs and would be sold. So they are saying that once you purchase, then 8 years you use it. At the end of 8th year, when you no longer require it, when you sell it off, you will get a salvage of rupees 4 lakhs. The existing machine, the old one, requires increasing amount of maintenance each year, and its salvage value falls each year as follows. So what they are saying is that if this existing machine today only if you sell, listen to me carefully, that existing machine today only you sell, which means you replace it with the new machine today only, then no maintenance cost you have to pay on the existing machine, and you will get a fat salvage of rupees 8 lakh. Everyone clear? You get a salvage of rupees 8 lakh today. However, if you decide to replace the existing machine with the new machine after 1 year from now, then to run the existing machine you will have to do a revamping cost of rupees 2 lakh, that is a maintenance cost of rupees 2 lakh that you have to incur to run the existing machine for 1 more year, and then when you sell it you will be able to get a lower salvage of rupees 5 lakh. If you decide to replace this existing machine with the new machine after 2 years, which means you decide to continue the existing for 2 more years, then children, do you realize you will have to not only spend 2 lakh in year 1 for the maintenance, additionally you will have to spend another 4 lakh at the end of year 2 for the maintenance, and then you will be able to sell that existing machine for rupees 3 lakhs. Then children, if you decide to replace the existing machine with the new machine after 3 years from here, then do you realize that for 3 years you will have to incur the maintenance costs. First year will be 2 lakh, second year will be 4 lakh, and third year children will be rupees 6 lakhs. Now children, if you decide to sell or replace this machine after 3 years, then do you realize you will have to not only spend 2 lakh in year 1, 4 lakh in year 2, but also 6 lakhs in year 3, and then when you sell the existing machine you will get only rupees 2 lakhs. And the last case, if you decide to replace the existing machine with the new machine in 4 years from now, then year 1 2 lakh you have to spend, year 2 4 lakh you have to spend, year 3 6 lakh you have to spend, and year 4 another 8 lakh rupees you will have to spend. And then when you go to sell it, you will get absolutely nothing, because by then the machine will be completely worth not selling. Everyone clear? The opportunity cost of capital for ABC is 15% required. When should the company replace the machine? Now children, normal replacement decision questions ask you, should you replace the machine or not? Here they are not asking you this, they are asking you when should you replace the machine, and children, this time value factors are given to you. Now students, whenever they ask you such a question, when should the company replace the machine, it means that they are talking about a concept called as replacement cycle. Okay, replacement cycle. Now what this is, students, do you realize here in front of you, you have got 5 options. Sir, what 5 options do we have? Replace today, replace after 1 year, replace after 2 years, replace after 3 years, replace after 4 years. Everybody clear? Either replace it today, or after 1, after 2, after 3, or after 4 years. We have to evaluate all 5 options. Everyone clear? We'll have to evaluate all 5 options. Now children, as you can see here, they have not given to you any cash revenues. Okay, they have not given to you any cash revenues. Of course salvage is there, that's a sundry cash revenue. The mainstream cash revenues are not given, the operating cash revenues expected are not given. So therefore the only option we have here for evaluating is, we cannot calculate net present value as in PV of CI minus PV of CO. The max we can do is calculate only PV of CO for each options. Present value of cash outflow for each option will calculate, and then we'll go for that option which is cheapest. Everyone clear? Because students, revenues are not given. When the revenues are not given, we understand them to be irrelevant, because they must be the same for all options, and therefore if the revenues are expected to be same for all options, they become irrelevant for decision making, and therefore we simply calculate the net cost of the project, right, and select the one which is cheaper or cheapest, because that project which is cheapest will of course eventually be having the highest NPV, assuming the revenues to be same. Everyone clear? Now you might be having a question, sir, if we are going to be calculating only PV of CO, what about that salvage? Children, salvage definitely we will be subtracting from the costs. Whatever data is given, we'll take it into consideration. Okay, so we will be calculating PV of CO only, and if there are any inflows here and there like salvage, we will be subtracting them from the outflows to get the net cash outflow and the present value of such net cash outflow. Everybody clear? But the final answer won't be NPV, because mainstream operating cash revenues are only not given. Everyone clear? So now let us go ahead. Second point, children, do you realize that these 5 options that I have, I told you we have to select that option which is cheapest. But do you realize that since their lives are different, right? The first option is having a life where we are replacing the existing machine today only, and then going for a new machine having a life of 8 years. Then in the second option, we are replacing the machine after 1 year, and then going for a new machine having a life of another 8 years. So do you realize every option, the years, the lives are different, and therefore you cannot compare their present values of cash outflow since the lives are different. And you must have been taught in capital budgeting that whenever such a situation arises, you have to divide that PV of CO by PVAF to find the annualized cost or equated annual cost. Everybody understanding? See, when it is NPV and different lives, we divide that NPV by PVAF to find the equalized annual gain or annualized benefit, right? And then compare the projects using that annualized benefit, annualized gain. Similarly here, we will calculate the annualized cost right? And then select the one whose annualized cost, that is EAC, is lowest. Everyone clear? Now let's start. So children, let us think about the first option. The first option is replace the machine, the existing machine today itself. So think what all cash flows will happen. Do you realize today, if I replace the existing machine with the new machine, do you understand that I will have to today spend 18 lakhs, correct? And today only, do you realize I'll be getting this salvage of 8 lakhs. I hope you are clear with this. 18 lakhs I have to spend today. And this machine, children, the existing machine, I need not be maintaining it further because today only I am selling it off. So straight away I'll get salvage of 8 lakh today only. This is happening today. Then children, the new machine starts for 8 years. Okay, for 8 years we will have to incur 2 lakh rupees per annum as the maintenance cost for the new machine, and at the end of the 8th year we will get a salvage back of rupees 4 lakh. Let us see how to calculate the present value of this option. So children, if you can see here, calculation of PV of CO, PV of net cash outflow. Option 1, replace today. Everybody clear? Option 1, replace today. So children, I hope you understand. Year 0, 18 lakh for the new machine, 8 lakh you will get back on the sale of the existing machine, 10 lakh will be the cash outflow today. Then for 8 years, children, do you realize 2 lakh rupees per annum will be your maintenance cost of the new machine, and at the end of 8th year you will get the salvage. I've put it in negative, it's an inflow, right, of rupees 4 lakh. We discount it, of course this is 1, this is PVAF of 1 to 8 years, annuity factor, and then discounting factor of last year. We get, children, we get the present value of net cash outflow for option 1, that is replaced today, as 17.67 lakh. Do you realize the life of this option is 8 years? Everybody clear? The life of this option is 8 years. Then children, tell me, what if you decide to replace the machine after 1 year? Okay, if you decide to replace the machine after 1 year. So children, if you decide to replace the machine after 1 year, today there won't be any inflow outflow, so no cash flow at end of year 0. End of year 1, children, do you realize you will have to spend 18 lakhs for purchasing the new. But students, I hope you are able to understand that at the end of year 1, you will also have to spend this 2 lakh rupees maintenance cost. Everybody are able to understand you have to spend this 2 lakh rupees maintenance cost for that 1 year that you maintained this existing machine. Everyone clear? And then when you sell off this existing machine, do you realize you will get 5 lakh. So basically at end of year 1, your net cash outflow will be 18 lakh plus 2 lakh minus 5 lakh. I'll show it to you here, children. Option 2, replace after 1 year. At the end of year 1, 18 lakh plus 2 lakh minus 5 lakh. 15 lakh is your net cash outflow at the end of year 1. Now children, the new machine begins at the end of year 1, and from there 8 years it will go. So children, do you realize from end of year 2 to end of year 9, everybody are able to understand, you will have to spend 2 lakh rupees per annum maintenance cost of the new machine, and at the end of the 9th year you will be getting back 4 lakh rupees salvage of that new machine. Children, if we calculate the present value, it comes to 19.71 lakhs. Next children, let's go to the third option. What is the third option? The third option is to replace the machine after 2 years. So children, if you decide to replace the machine after 2 years, today, that is end of year 0, no cash flow. At end of year 1, do you realize you will have to incur this cash flow of rupees 2 lakh to maintain that existing machine? Correct? So at end of year 1, children, do you realize if you decide to replace after 2 years, at end of year 1, 2 lakh rupees, okay, 2 lakh rupees you will have to incur to maintain the existing machine. Then children, comes year 2. The year of main action. In year 2, can I say you have to spend 18 lakhs now to purchase the new machine. You will have to spend another 4 lakh to maintain the existing machine for the second year. And then when you sell off the existing machine at end of year 2, you will get 3 lakh rupees back. So the cash flow at end of year 2 will be 18 lakhs plus 4 lakhs minus 3 lakhs, correct? End of year 2, 18 plus 4 minus 3, 19 lakhs. And then children, from end of year 2 onwards till end of year 10, 8 more years, the new machine will run. So children, do you realize that the cash flows, right, the maintenance cash flows will start from end of year 3 till end of year 10? Everyone clear? And that will be, children, 2 lakh rupees per annum, and at the end of the life, 10th year, you will be getting a salvage of rupees 4 lakh back. If you calculate the present value of cash outflows, it comes to rupees 21.9. So children, this was option 3, replace after 2 years. Now let's talk about option 4, replace after 3 years. If you decide to replace after 3 years, today no cash flow, end of year 1, 2 lakhs, end of year 2, 4 lakhs, end of year 3, 18 lakhs for the new machine plus 6 lakhs maintenance of the existing machine, and then sell off the existing machine for rupees 2 lakhs. So 18 plus 6 minus 2. I'll show it to you, children, here. Correct? Replace the machine after 4 years. For the first 2 years, of course, you will be maintaining the existing machine. Third year, you will purchase the new machine, maintain the existing machine, or basically pay for the maintenance of the third year, and then sell it off at rupees 2 lakhs. Everybody clear? So children, that gives you 22 lakh rupees cash outflow net at the end of year 3. Then from end of year 3 to end of year 11, 8 years, this new machine will run, for which your cash flows of maintenance will start from end of year 4 till end of year 11, 2 lakh rupees every year, correct? And at the end of 11th year, you will be getting the salvage back. Students, if we calculate the present value of cash outflow, it comes to 24.27 lakh. So now let us understand this particular option, that is to replace the machine after 4 years. If you decide to replace the machine after 4 years, children, I'm pretty sure you understand years 1, 2 and 3, you'll have to incur the maintenance cost of the existing machine. End of 4th year, you'll have to spend 18 lakhs for the new machine, incur 8 lakhs for the maintenance of the existing machine for the 4th year, and when you sell, you will be getting absolutely nothing. So can I say 2, 4 and 6 for the first 3 years, 2, 4 and 6, and at the end of the 4th year, 18 lakhs plus 8 lakh minus 0, correct? 18 lakhs plus 8 lakh minus 0, 26 lakh, children, will be your cash flow at the end of 4th year. From end of year 4 to end of year 12, your new machine will run. It's a 8-year project, 8-year machine. So your cash flows for maintenance will start from end of year 5 to end of year 12, 2 lakh rupees per annum. At the end of year 12, children, you will be recovering 4 lakh rupees salvage, and that will result in a present value of 27.96. So with that, we complete the calculation of PV of CO for each of the options, correct? PV of CO for each of the options, but we can't compare them. We will have to calculate the annualized cost, for which we will have to divide by the respective periods, PVAF. So children, option 1 has a life of 8 years, option 2 has a life of 9 years, then 10 years, 11 and 12. We will have to divide by the PVAF of these respective years. So I am writing down here calculation of equated annualized cost. Now children, first of all, option 1, 2, 3, 4, 5. Life is 8, 9, 10, 11 and 12. PV of CO we just now calculated, correct? For each option, I divide by PVAF of 15%, 8 years, 15%, 9 years, 15%, 10 years, 15%, 11 years, 15%, 12 years. What I get is the equated annualized cost. Everyone clear? Equated annualized cost. So 17.67 divided by 4.4873. The equated annualized cost comes to 3.94 lakhs. 19.71 lakh divided by 4.7716 will give you 4.13 lakh, and so on. And as you compare these cash flows, you realize that the option 1, correct, that is replace the machine today itself, is the best since it is cheapest. Everybody clear? So therefore we should replace machine today since its equated annualized cost is lowest. Everyone clear what I am trying to explain to you here? Okay, it's a new concept for many of you. I hope you understood the concept of replacement cycle, right? So what are we supposed to do here? We are supposed to calculate the PV of CO of all different options we have. Replace today, replace after 1 year, 2 year, 3 year and 4 year, and then we should calculate the annualized cost since the lives are different, and then select the option whose annualized cost is lowest, right? That is option 1, replace today. Now children, if you see institute solution, the conclusion is exactly same. Numbers also same, only they have taken. Their methodology is slightly different, but that's okay. If you feel you're more comfortable with that, then kindly go ahead with that. In fact, I would recommend you go ahead with that. This is my methodology of solving this question. Everyone clear? So children, with that we complete the discussion to question number 5, that was based on capital budgeting, investing decisions. Now let us go to the next question, that is from the chapter of risk analysis in capital budgeting. Let's start. Now this question, children, is based on this concept of scenario analysis from the chapter of risk analysis in capital budgeting. Now what did we do in scenario analysis? 3-4 scenarios will be given. You have to simply calculate NPV for each scenario, normal NPV for each scenario, question over. That's it. Okay, let's start. They're saying ASG Limited is considering a project with an initial investment of 15 lakhs and life of 5 years. Note this, 15 lakh will be initial investment, life is 5 years. Estimates of projects are as follows. Now children, can you see they have given to you lower estimates, base estimates and upper estimates. Institute is translating this as worst case, okay, worst case. Then there is a base case, that is like a normal case, and the best case, okay, best case. So this is the worst case, this is the base, and this is the best case. Everybody clear till here? Okay. Now what could be worst case? Worst case could be a situation where selling prices are low but the costs are high. Everyone clear? Selling prices are low, costs are high. What could be the best case? Where selling prices are high, okay, selling prices are high and costs are low, correct? Costs are low. So let us analyze, children, the worst case first, okay? Let us analyze the worst case. If I talk about worst case, do you realize the lowest selling price it can get is 175 rupees per unit? So can I say 9,000 units? In fact, in the worst case, children, do you realize even the units sold will be lowest, and in the best case the units sold will be, of course, the highest. That is given in the table itself, right? Moving on. So 9,000 units only you are able to sell in the worst case. So 9,000 into the lowest selling price 175. Can I say 15,75,000 will be your expected cash revenues, correct? Expected cash revenues if you go for the worst case assumption. Then children, going on to the costs. As far as the costs are concerned, they have given to you 3 costs, 100, 125 and 150. Please note these costs or this table is not continuing from the above table. Instead of saying this is an independent separate table, and therefore children, for the worst case, do you realize we will be taking the highest cost, which is rupees 150 per unit. Everybody clear? Which is rupees 150 per unit. So 9,000 units in the worst case multiplied by 150 rupees per unit. Children, do you realize 13,50,000, okay, 13,50,000 will become your variable cost, correct? And then they are also saying that fixed cost, children, the worst is 2 lakh rupees, highest fixed cost. That also if I subtract, correct, 2 lakh rupees if I subtract, do you realize I will get my net profit? But before I go on to the net profit, they are saying that in those fixed costs of 2 lakh, depreciation included is rupees 70,000, okay, depreciation included is rupees 70,000. So children, 15,75,000 minus 13,50,000 minus 2 lakh, if I do, I get 25,000 rupees. Now children, this is not net profit before depreciation and tax, because depreciation is already embedded in this 2 lakh rupees. So this straight away becomes net profit before tax. Everyone clear? From this net profit before tax, we have to simply subtract the tax at 25%. I'll show it to you, children. Can you see earnings before tax? for the worst case. Everyone clear? Earnings before tax for the worst case is 25,000. From that we subtract tax. Do you realize what we get is earnings after tax? Correct? Earnings after tax. And children, you all know to calculate cash inflows for the purpose of calculating NPV will be CFAT, that is cash flows after tax, for which we need to add back that 70,000 depreciation which was included in this fixed cost. When you add it back, children, do you realize you will get cash inflow per annum of rupees 88,750. So children, 88,750 is your cash inflow per annum which you will receive for a period of 5 years. So can I say the present value of cash inflow in the worst case will be 88,750 multiplied by PVAF of 15% 5 years. Everybody clear? Multiplied by PVAF, right? It's an annuity cash flow. Every year same cash flow you're getting 88,750 multiplied by PVAF will give you the present value of cash inflow, and present value of cash inflow minus present value of cash outflow, the first line they are given to you, initial investment. Yes, you will get the NPV of the worst case as a huge negative NPV of around 12 lakh rupees. Everyone clear? Now let us discuss the base case. Children, if you are discussing about the base case, do you realize that the revenues will be 10,000 into 200, the base selling price? So 10,000 into 200, 20 lakh rupees. Okay, 20 lakh rupees will be, okay, the revenues. As far as variable cost is concerned, we will take the base one, that is the middle one, that is rupees 125. So children, if I take 125, 10,000 units into 125 rupees per unit, 12,50,000 will be the variable cost. Okay, 12,50,000 will be the variable cost. As far as fixed cost is concerned, again the middle one, we are expecting it to be rupees 1,50,000. So children, the fixed cost will be rupees 1,50,000. So if I take the calculator, this will be 20 lakhs minus 12,50,000 minus 1,50,000. Children, this comes to NPBT, yeah, EBT, right? NPBT or EBT, it is earnings before tax or net profit before tax, as rupees 6 lakhs. I'll show it to you here. Here you can see this rupees 6 lakhs for the base case. Then I'm pretty sure you know what to do. Minus tax will give NPAT plus depreciation of 70,000. You will get cash flows after tax. These cash flows after tax, because they will happen at the end of every year for the next 5 years, the present value of cash inflows will be 5,20,000 multiplied by the PVAF of 15% 5 years. Correct? That you will get a PV of CI as 1743,560 minus the PV of CO of rupees 15 lakhs. You will get the NPV as a positive 243,560. Now children, let us analyze the best case. Children, as far as best case is concerned, tell me how much will be the revenues. 11,000 units into 225. 11,000 units into 225. 24,75,000. So the units into selling price give you revenues of 2475. As far as variable costs, the lowest rupees 100 per unit. So 11,000 units into 100 per unit will give you 11 lakh rupees as the variable cost. Okay, 11 lakh rupees as variable cost, and lowest fixed cost of rupees 1 lakh. Lowest fixed cost of rupees 1 lakh, children, if I take here, okay, this will be 2475 minus 11 lakh. Okay, 2475 minus 11 lakh minus 1 lakh. This is 12,75,000. 12,75,000 per annum. NPBT or EBT. Okay, you can see here 12,75,000 for the best case. Correct? And then you know what to do. Less tax, you will get NPAT. Add depreciation, you will get CFAT, that is cash inflow. That CFAT multiplied by PVAF for 5 years will give you present value of cash inflows minus present value of cash outflow will give you the net present value. With that, we complete the scenario analysis, that is calculation of NPV for each scenario. And with that, we complete this question number 6 of your RTP on this chapter of risk analysis in capital budgeting. Let us now go to the next question, which is based on the chapter of dividend decisions. Let's start. This question, children, from dividend decisions is based on the concept of Walter's model, Walter's formula. I hope you remember that the value of equity, okay, value of equity is nothing but D plus E minus D into R by K, the whole upon K, right? This was dividend decisions Walter's model. Children, let's start. The following figures have been calculated from the annual report of ABC Limited for the current financial year. So net profit, children, net profit after tax is given to you as 75 lakhs. Outstanding 12% preference shares are 250 lakhs. Children, 250 lakh preference share capital into 12%. So 250 into 12%, if I do, that comes to a preference dividend of rupees 30 lakhs. So children, do you therefore realize that the net profit available for equity shareholders will be 75 lakh minus 30 lakh. So 75 lakh minus 30 lakh, 45 lakh is the net profit available for equity shareholders. You know, right? NPAT minus preference dividend gives you net profit available for equity shareholders, and that if I divide by number of equity shares, okay, if I divide by number of equity shares, I get the EPS, that is E, as rupees 6. Everybody clear? We get E as rupees 6. Then return on investment, that is ROE, is given to you as 20% and KE is given to you as 16%. So children, out of this formula, can I say we already have E here, we have R here, and we have KE. Now the only things left are D or V bracket E, one of the two. If they give us, the other we can find. So what they are saying is, compute the approximate dividend payout ratio so as to keep the share price at 42 by using Walter's model. So now in this question, it is a reverse question. As I told you, they have given to you value of equity. They are saying we want 42 rupees as the value of equity. You find out the dividend. Everybody clear? You find out the dividend. So students, if I put numbers here, do you understand that 42 is equal to D plus 6 minus D, correct, into R by K, that is 0.20 by 0.16, the whole divided by 0.16. We have to simply solve this and get the D. And children, whatever D you get, that divided by the earnings per share will give you the dividend payout ratio to keep the share price at rupees 42. So children, if you see this question from Institute Solution, same thing they have done. 75 lakh net profit minus preference dividend will give net profit available for equity shareholders. Divide by number of equity shares, they get the EPS as 6. Then children, the equation that I showed you here, same thing they have done here, and they went on to solve it and they got the dividend as rupees 3.12. Everybody clear? They got the dividend as rupees 3.12. So the dividend payout ratio should be how much? Out of 6 rupees, 3.12, if it has to be paid out, then the required dividend payout ratio will be 52%. Everybody clear? So if the dividend payout ratio is 52%, then out of 6 rupees earnings, you will be able to pay 3.12 dividends. If 3.12 dividends you are paying, then according to Walter's model, the share value will be rupees 42. That's what they're asking you in point number A, right? 52% is the answer. Point number B. Determine the optimum dividend payout ratio. Now children, optimum dividend payout ratio, as you know, according to Walter, depends on the comparison between R and KE, correct? So children, here you can see that R is greater than KE, right? R is greater than KE. So since R greater than KE, you know from the Walter's model, you must have been taught that since R is greater than KE, the optimum dividend payout ratio should be 0%. Okay, optimum dividend payout ratio should be 0%. If you take it as 0% payout, the value of equity according to Walter will be highest. Let's check the solution, children. What are they saying? Since R greater than KE, the optimum dividend payout ratio would be 0. Everyone clear? It would be 0, and if dividend payout is 0, of course D also will be 0. Then they are saying also calculate the price of the share at such a payout. Recalculate the value of equity. Take everything same. It is just that instead of D as 3.12 or whatever, take D as 0. Everybody clear? So the calculation will be something like this. Okay, it will be that value of equity is equal to 0 plus 6 minus 0 into 0.2 by 0.6, the whole upon 0.6. That is what they are asking you, the price of the share. So children, if you can see, the same thing they have done here, and they have got the price of the share as rupees 46.875. So children, what Walter says, any other payout ratio you check apart from 0, apart from 0, if R is greater than KE, that any other payout ratio, may it be 25%, 50%, 75%, 100%, 33%, do what you want, the value of equity won't be greater than this. This is the maximum share price that you can achieve according to Walter, in case R is greater than KE, and if you follow Walter's advice of optimum dividend payout ratio of 0%. Next children, point number C. They're saying prove that the dividend payout ratio as determined in point B above, that is 0%, is optimum by using random payout ratio. So basically what they are saying is that you are saying no, that any other payout ratio will give you a price less than this. Show, prove it. Only if you prove it, then only we'll agree that this is the optimum dividend payout. So what institute has done, they are saying that okay, let us randomly take any payout ratio, 25%, 50%, 75%. Children, if they are taking a 25% payout, 6 rupees is the EPS. Can I say 6 into 25%? 1.5 will be the dividend. If they are taking a 50% payout, 6 into 50%, 3 rupees will be the dividend. At 75% payout, 6 into 75%, 4.5 will be dividend. And they're taking one more, 100% also they're taking. At 100% payout, the entire 6 will be the dividend. Children, in all these cases, they have calculated that same Walter's model, and you can see the prices that they are getting are of course less than this price, 46.875. So what is the conclusion? From the above, it can be seen that price of share is maximum when dividend payout ratio is 0, as determined in B above, and hence it is proved. Everyone clear? So with that, we complete the discussion to this question number 7, based on dividend decisions. Now let us go on to the next question, that is from the chapter of cash budget or cash and treasury management. Let's start. Now this question, children, which is from the chapter of treasury and cash management, belongs actually to the concept of cash flow statement. This question is there in a study module also. So let us try to understand this. You are given below the profit and loss account for 2 years for a company. So they have given to you year 1 and year 2 P&L, okay? Both the debit and credit sides, it goes down till here. Then they are saying sales are expected to be 4 crore 80 lakhs in the next year, year 3. As a result, other expenses will increase by 20 lakhs besides other charges. Only raw materials are in stock, which means they are saying that this opening stock and closing stock are only of raw material. There is no WIP or FG here. Assume sales and purchases are in cash terms, and the closing stock is expected to go up by the same amount as between years 1 and 2. So basically what they are trying to say is that if you are assuming sales and purchases to be on cash terms, there are no receivables, there are no payables, no debtors, no creditors. And as far as stock is concerned, it is expected to go up by the same amount as between years 1 and 2. You may assume, that no dividend is being paid. The company can use 75% of the cash generated to service a loan. Compute how much cash from operations will be available in year 3 for the purpose, ignore income tax. Now students, when they say cash from operations, I hope you are reminded of cash flow statement. Now, when you used to do cash flow statement to calculate cash from operations, children, there used to be 2 methods. One was the direct method and one was the indirect method. In this question, considering the data given, we will be using the indirect method to calculate cash from operations, where we start with net profit for the year, then we do the adjustments, right, where we then get the net profit before the working capital adjustments, then we adjust for the working capital changes, and then we get the final cash from operations. Okay, but before we do the CFO calculations, the cash from operation calculations, we will have to do the net profit calculation, right? Because only from that net profit we can do the adjustments and get the cash flow from operations. So the first goal that we should all be having is to calculate the net profit projected for year 3. Everybody, you are able to understand, because for year 3 only we want to calculate that CFO, right? Now let's imagine a PNL, right? Because we have to make a PNL to find out the projected net profit for year 3. So on the PNL, on the credit side, can I say sales will be there and miscellaneous income will be there? Everybody clear? There will be sales and there will be miscellaneous income. Now as far as sales is concerned, they have very clearly given it to you as rupees 4 crore 80 lakh, that is 480 lakhs. Everybody clear? So I'll take you to the solution, children. Can you see projected PNL for year 3 by sales? This is given to you, correct? This is given to you as 480 lakhs. Also concerning the miscellaneous income, since they are same every year, we'll assume it to be same in year 3 also, and therefore I will take 4 lakh as the miscellaneous income. Everyone clear about the credit side? Let us now jump to the debit side. Now students, as far as debit side is concerned, the costs are concerned, do you realize variable costs will exactly increase in the same ratio, the same proportion, the same percentage as the sales have increased, right? Here if you can see, as far as year 2 was concerned, 400 lakh was the sales of year 2. In year 3, they say that the sales will go to 480 lakhs. Now children, a jump from 400 lakhs to 480 lakhs is an obvious 20% jump. Everybody clear? Which means, do you understand that sales have increased, or they are expected, projected to increase by 20%, and therefore on the debit side of the P&L, all those costs which we can consider to be variable will also increase by 20%. Everybody clear? Now first of all, on the debit side, I would like to talk about a cost called as raw materials consumed. Now students, raw material consumed is what? It is opening raw material plus purchases, correct, minus closing raw material. Everybody understands opening raw material plus purchases minus closing raw material. Now opening raw material, tell me, for year 2 we will be discussing, because from year 2 only we will be jumping to year 3. Year 2, can I say opening raw material is 40 lakhs, correct? Purchases are 1 crore 60 lakhs, that is 160 lakhs, and the closing stock, children, can I say is 60 lakhs. Everyone clear? Closing stock is 60 lakhs. So 40 lakhs plus 160 lakhs minus 60 lakhs, do you realize will become the raw material consumed for year 2, the immediate previous year to year 3, and raw material consumed being obviously a variable cost will also be expected to increase by 20%, the same ratio in which the sales also went up. So children, I will take you to the P&L. Did you understand this? 40 lakhs, correct, plus 160 lakhs minus 60 lakhs plus 20% will give you raw material consumed as 168 lakhs. Everybody clear? For year 3 projected. Then opening raw material, closing stock all done, sales done, miscellaneous expenditure done. Now the only debit side expenses are left. Stores, children, again stores, we will assume it to be variable cost, and therefore do you realize that if in year 2 the stores cost was 48 lakhs, it will increase by 20%. So if it increases by 20%, 48 lakhs plus 20%, 57.6 lakhs will be stores. Next children, manufacturing expenses in year 2 was 64 lakhs, assuming them to be variable. Do you realize manufacturing overheads, children, will be 64 lakhs plus 20%, that is 76.8 lakhs. Next children, do you understand other expenses? Now other expenses, they appear to be fixed, right? 40 lakh, 40 lakh. If nothing would have been given to us in the question, I would have continued 40 lakh, but they are very clearly saying that as a result that sales increased, other expenses will increase by 20 lakhs. They are saying other expenses won't remain fixed, they will increase by 20 lakh. So if in year 2 the other expenses were 40 lakhs, do you realize that in year 3 they will be 40 lakhs plus 20 lakhs, that is 60 lakhs. Everybody clear? 40 lakh plus 20 lakh, that is 60 lakhs. Then children, the last expense, depreciation, nothing is mentioned, it appears to be fixed, and since it is fixed we will continue it to be fixed, 40 lakhs. With that we take all the expenses into consideration and we end up at a net profit as 81 lakh 60,000. Now this is the projected net profit for year 3. Let us now use the indirect method from cash flow statement to find out the cash from operations. So I'll write down here calculation of cash from operations for year 3. Do you remember this technique? Net profit, then adjustments for depreciation, etc. You get net profit before working capital changes, then you do adjustments for the working capital changes, and then you get the final cash from operations. This 81.6 we just now got from the P&L upstairs. Then of course children, I hope you understand that there was a depreciation also, a non-cash expenditure that you had subtracted, which will be needed to be added back to find the cash flow. So that depreciation children, we add back 40 lakhs, right? This 40 lakhs we add back and we get the net profit before working capital changes. Then moving on to working capital changes children, there are no receivables here, no payables here, stock is there. Now what about stock? They are saying that the closing stock of year 3 is expected to go up by the same amount as between years 1 and 2. So children, here if you can see, between years 1 and 2 the closing stock has gone up by 20 lakhs, right? From 40 lakhs it went up to 60 lakhs. They are saying this 20 lakh jump will remain constant between year 2 and year 3 also, and therefore from 60 lakh it will jump by 20 lakh. Increase in stock children, increase in stock, can I say, will be subtracted from your net profit. So children, adjustment for increase in closing stock, that is 60 lakh minus 40 lakh, 20 lakh, do you realize, will be subtracted. We will get the cash from operations as 101.6 lakhs. Everybody clear? 101.6 lakhs. Now from this 101.6 lakhs, they are telling that you can use 75% of this cash from operations for servicing a loan. So children, if 75% of this will be used for servicing the loan, amount for servicing the loan will be 101.6 lakh into 75%, that is 76.2 lakhs. Everyone clear? I'll take you to the institute solution children. This is the institute solution here. Now in the institute solution, if you can see, they have eventually got amount available for servicing the loan is 76.2 lakhs and 101.6, everything we have got as it is. Everyone clear? So with that we complete the discussion to question number 8 of RTP. And now moving on to the last question, the last practical problem, that is from the chapter of management of working capital. Children, this question, the numbers are slightly different, but what I propose is, instead of me solving this entire question again, I will again pull out one video from my video library, that is the online product that I was talking about, and in that particular video library I have got one question which is a replica of this question. It is just that numbers are different, okay? Only numbers are different. I'll pull out that video and I will show it to you. Go through that entire question. You will then be very easily able to solve this also. Everyone clear? So I'll now show that particular video to you. We'll meet you at the end of that video. Please watch. This question, children, is based on the concept of a newly formed company that you have already studied, and that too with the inclusion of WIP. So children, when it is a newly formed company with WIP data given, I hope you remember how to make the cost structure. There will be particulars, then there will be 4 finished goods, then there will be 4 WIP, and then at the end it will be total, right? So let's start reading this question. PQ Limited, a company newly commencing business, correct, in 2021 has the following projected profit and loss account. So they have given to you sales minus COGS will give gross profit, minus admin overheads, selling distribution overheads will give EBT, minus tax will give NPAT. Then regarding this particular COGS, they are saying that the COGS has been arrived at as under raw material consumed, wages, depreciation, and then less stock of finished goods will give you COGS. Now students, I hope you realize that materials consumed, that is raw materials consumed, plus wages and manufacturing overheads, and plus depreciation, which we are assuming to be manufacturing, children, can I say, will give you cost of production. And then in that cost of production you add opening FG, which will be 0 because it is newly formed, less closing FG, which is given to you as 17,000. You will get COGS as 1,53,000, which they have taken here. Okay, next. The figures given above relate only to finished goods and not to WIP. So basically they are saying that when you will be making the cost structure, this is not the total cost structure, this is only for the manufacture of finished goods. Goods equal to 15% of year's production in terms of physical units will be in process, that means in WIP stock on an average, requiring full materials, which means 100% materials, but only 40% of the other expenses. I hope you understood this line, only 40% of the other overheads. The company believes in keeping materials equal to 2 months consumption in stock. This is your RMCP, correct? RMCP, raw materials conversion period. All expenses will be paid 1 month in advance. So children, this becomes your prepaid expenses. Suppliers of materials will extend 1.5 months of credit. This is your payables conversion period, that is PCP, correct? Sales will be 20% for cash and the rest at 2 months credit. This is your receivables conversion period. 70% of the income tax will be paid in advance in quarterly installments. We'll deal about this in some time. The company wishes to keep 8,000 in cash. This is your cash. 10% has to be added to the estimated figure for unforeseen circumstances. This is your safety margin, right? At the end, you will add 10% for safety margin. Prepare an estimate of working capital. All working should form part of the answer. Are you ready? Now students, since this is a question where it is not very clearly mentioned whether you're supposed to do on total basis or cash cost basis, we will do it on cash cost basis. Everybody clear? We'll do it on cash cost basis. So children, let's start. So what I will do is I'll first of all write down working note 1, that is cost structure. Okay, working note 1, cost structure. In cost structure, we will make these columns particulars. Okay, then we'll write for finished goods, then we'll write for WIP, and then we'll write total. Everyone clear? For finished goods, for WIP and total. Now students, let's start. Raw materials consumed. Tell me, raw materials consumed as far as finished goods are concerned, can I say are 84,000? So I'll write down here 84,000, correct? Next children, we have got wages. Now wages as far as finished goods are concerned, and that is including manufacturing overheads. So wages and manufacturing overheads are 62,500. So I'll take here 62,500, and since we are doing it on cash cost basis, we will not take depreciation into consideration. Moving on to WIP. Students, as far as WIP is concerned, do you realize if you spend only 84,000 rupees, then only your finished goods will be produced throughout the year. You will not be able to get a closing WIP stock. Since it's a newly formed company, I cannot assume we already have an opening WIP stock. So for ensuring that apart from the finished goods, we also have a closing WIP stock, you will need to spend something extra. Now how much extra? They are saying goods equal to 15% of year's production will be in process. Okay, that means WIP stock will be around 15% of the year's production, and it will require full materials. Now children, if it is going to require full materials, then look at the calculation. Do you realize 84,000 rupees is the cost we need to incur in raw materials for manufacture of finished goods? Into 15% if I do, Then children, do you realize that is the raw materials required for WIP? Of course, into 100%, because full materials are required. Everyone clear? So children, if you take the calculator, okay, this is 84,000 into 15%, that is of course into 100%, that is 12,600, and therefore the total raw material consumed throughout the year will be 84,000 for the annual finished goods production plus 12,600 for the WIP stock. The totals to 96,600. Everyone clear? Similarly, for wages, children, can I say for wages, 62,500 is the wages required for finished goods, 15% is in WIP, but now the entire wages and manufacturing overheads, the entire conversion costs won't be taken, otherwise that WIP will also become finished goods. Only 40% of the other expenses. So children, I'll write down into 40%. So 62,500 multiplied by 15% multiplied by 40%, 3,750, correct? 3,750 will be the wages and manufacturing overheads required for WIP. So 62,500 plus 3,750, this will come to 66,250, correct? 66,250. So with that children, if you go down, do you realize you will get gross factory cost, correct? You will get gross factory cost, and you will also get the WIP stock. The WIP stock, children, do you realize will be 12,600 plus 3,750, that comes to 16,350. And as far as total is concerned, the total gross factory cost will be 96,600 plus 66,250, and children, that comes to 1,62,850, correct? 1,62,850. In that, students, we will add opening WIP, which is dash, we'll subtract closing WIP, that is 16,350, and what we get will be the cost of production, correct? We'll get cost of production. Net factory cost and cost of production we are taking to be same. So 162,850 minus 16,350, that will come to a COP of 1,46,500, which of course is nothing but the total, right, of this column here. If you take the calci, 84,000 plus 62,500 of course is 146,500. Same number now. Now children, can I say we have reached COP as 146,500? This is purely now for the finished goods. Let's now go ahead, add opening FG, which will be dash, less closing FG. Now children, as far as closing FG is concerned, they have given it to you as 17,000, correct? You can see here in the question, they are saying that stock of finished goods, that means the closing stock of finished goods will be 17,000. But in this 17,000, there is a small thing that you need to change. How did they calculate 17,000? They are saying stock of finished goods here, they are not taking any FGCP, nothing. Straight away they are saying whatever is the COP, cost of goods produced but not yet sold, whatever is the COP, 10% of the same. Everybody clear? 10% of the same. Here the COP, children, can I say is 1,70,000, and 10% of the same will give you 17,000 rupees as the closing stock of FG. Tell me what change we'll have to do. This 170, can I say, includes 23,500 also. Everybody clear? This 170 includes 23,500. We need to remove that, and then on the balance COP, 10% we will have to calculate. Everybody clear? So children, that we already have, right, that COP without depreciation 146,500 we already have. This 146,500 is nothing but 1,70,000 minus 23,500, correct? Here we have not taken that depreciation element, right? So automatically this 146,500 is the cash COP, that is the COP without depreciation. So can I say that the closing FG will be 10% of 146,500? Everybody clear? 10% of 146,500, and that will come to 14,650, correct? 14,650. So when we go down, we'll get cost of goods sold. So 146,500 minus 14,650, this will come to 131,850, right? This is your cost of goods sold, 131,850. In that, children, we add the office admin overheads, we add the selling distribution overheads, which are given to you in the question as 14,000 and 13,000. Correct? You can see that 14,000 and 13,000. So I'll write down here 14,000, I'll write down here 13,000, and what we get will be your final cost of sales. So 131,850 plus 14,000 plus 13,000. So this will, children, come to 1,58,850. So with that, we complete the cost structure. Correct? We complete the cost structure. Now let us go on to working note 2, that is operating cycle. Okay, working note 2, that is operating cycle. As far as operating cycle is concerned, what all periods are given to you? First of all, children, I'll just remove all these markings, okay, so that we get complete clarity on whatever is there. So this line nothing is given, this line nothing, this line nothing. Here, children, can you see they are saying that your RMCP is 2 months. So I'll write down here raw materials conversion period is 2 months. Then students, we have got all expenses will be paid 1 month in advance. So can I say prepaid expenses 1 month? Then children, we have got suppliers giving us 1.5 month credit. So the payables conversion period will be 1.5 months. Then we have, the debtors to whom we are giving 2 months credit. So RCP will be 2 months. I'll write down here RCP 2 months. And then students, 70% of income tax will be paid in advance in quarterly installments. So can I say that your prepaid income tax, okay, will be 3 months because you are paying in advance in quarterly basis, right? Then children, company wishes to keep 8,000 in cash. That's it. So there is no more period data given. That's it. So now let's go on to our final statement. Okay, I'll write down here statement showing estimation of working capital on cash cost basis. Okay, statement showing estimation of working capital on cash cost basis. Serial number, particulars, calculation, amount. Everyone clear? Serial number, particulars, calculation, amount. Now in serial number, we write current assets. Okay, in serial numbers we write A, current assets. In that, the first current asset, children, is raw material stock. As far as raw material stock is concerned, can I say it will be total raw material consumed 96,600 multiplied by 2 by 12, raw materials period 96,600, correct, 96,600 into 2 by 12. So I'll take the calculator, 96,600 into 2 divided by 12, we will get 16,100 as the RM stock. Then children, we have got WIP stock that we have already calculated in working note 1 above, right? The WIP stock we had got was 16,350. So I'll write down here 16,350. Then students, we have got the finished goods stock, which also we have calculated in working note 1 itself, right? The finished goods stock that we have already calculated was 14,650, correct? 14,650. I'll write down here 14,650. Then comes debtors. Now as far as debtors are concerned, we have to be slightly alert here. First of all, what are the cost of sales? 158,850, correct? 158,850. So I'll write down here 158,850. But children, all the sales are not on credit. Do you see here that 20% is for cash, which means only 80% is on credit? So therefore I'll multiply this by 80% to get the cost of credit sales, correct? Cost of credit sales. This 158,850 is the cost of total sales. But for debtors, we'll require the cost of credit sales only. And then we'll multiply by the receivables period, that is 2 months. So into 2 by 12, correct? Into 2 by 12, we'll take the calci 158,850 into 80% into 2 divided by 12. Children, this will come to 21,180 as the debtors. Next, we have got cash. As far as cash is concerned, they have given it to you in the question as rupees 8,000. So we'll take it as 8,000. Then we have got prepaid expenses, correct? We have got prepaid expenses. They are saying all expenses are paid 1 month in advance. So when I say all expenses, which all expenses will come? Students, I'll just mark it for you here. Okay, there will be wages and manufacturing overhead 66,250. I'll write down here. Okay, 66,250. All right, I'll write down here 66,250 plus. Apart from wages and overheads, do you realize you have got office admin overheads, selling distribution overheads as 14,000 and 13,000. That's it. So 14 and 13. So I'll write down here 14,000, 13,000. And children, do you realize all of them are outstanding for 1 month? Everyone clear? All of them are outstanding for 1 month. So here we will multiply by 1 by 12. So we'll take the calculator and solve this. So this is 66,250 plus 14,000 plus 13,000, okay, divided by 12, and that children will come to 7,771. Okay, 7,771. Apart from that children, we also have the advance tax. Okay, advance tax. Now as far as advance tax is concerned, do you understand that here that provision for tax taken is 10,000? Okay, the provision is 10,000, and of this 10,000, do you realize that 70% is payable in advance? So children, do you therefore realize that 10,000 into 70% is what is being paid in advance, and since it is being paid on a quarterly installment basis, the prepaid will be into 3 by 12. Everybody clear? The prepaid will be into 3 by 12. So basically 7,000 into 3 divided by 12. So that will children give you 1,750 as the advance tax. So with that we complete the entire gross working capital. Let's take the calculator and calculate the gross working capital. 16,100 plus 16,350 plus 14,650 plus 21,180 plus 8,000 plus 7,771 plus 1,750. Children, this will come to 85,801. Okay, 85,801. Let's now go on to point number B, current liabilities. So as far as current liabilities are concerned, the first current liability is of course creditors. Now children, for creditors, I hope you realize you will require a working note 3 because purchases need to be calculated separately. So right now just keep it open. Now children, do you realize the second one is provision for tax, correct? There is a provision for tax 10,000. Now out of 10,000, if 7,000 you are paying in advance, are you all understanding? See, there is a provision for tax here, correct? 10,000. Now out of 10,000, if 7,000 you are paying in advance, do you realize that the balance will simply be 10,000 into 30%. Everybody clear? 10,000 into 70% is payable in advance. So the liability, the provision will only be 10,000 into 30%, that is rupees 3,000. So with that children, we complete all the discussion except creditors, correct? We have completed everything. Raw materials taken, prepaid expenses taken, creditors we will be taking now in some time, debtors taken, and prepaid or advance income tax taken. Now let us go for the creditors children. So here I'll write down working note 3, calculation of creditors. Now children, we all know that purchases are nothing but raw materials consumed minus opening raw material plus closing raw material, correct? Opening raw materials have to be subtracted from RMC. Closing raw materials will be added to RMC. Now children, what was your RMC? Your RMC, if you remember, was 96,600, correct? 96,600. So I'll write down here 96,600. Opening RM is of course 0, newly formed company. Closing RM we had calculated some time back, right, in our estimation of working capital, first point as 16,100. So I'll write down here 16,100. We will take the total 96,600 plus 16,100. This comes to 1,12,700 as our purchases, and therefore our creditors will be purchases multiplied by, okay, purchases multiplied by PCP, that is 1.5 months. Okay, 1.5 months. So I'll write down here into 1.5, of course, divided by 12. So 1,12,700 multiplied by 1.5 divided by 12, and children, this comes to 14,088 as your creditors. So we take this 14,088 and we place it here, and the total current liabilities therefore students will come to 17,088, and we get the net working capital excluding safety margin, correct, excluding safety margin as 85,801 minus 17,088, correct, we get it as 68,713, correct, 68,713. How much is the safety margin they're asking you to add? 10% has to be added for unforeseen contingencies. So we add safety margin at the rate 10%. So 68,713 into 10% is obviously 6871, and if you add, you will get net working capital including safety margin, okay, as 68,713, okay, 68,713 plus 6871, and that will come to 75,584. Everybody clear? 75,584. This is your final answer of this question. I hope you understood the discussion of the entire question. Okay students, so I hope you all saw that entire video, and I hope you understood this question is very similar to that question. So this is also done. Now children, moving on to the theory part, miscellaneous question number 10, point number A. They are saying profit maximization is not the sole objective of a company. It is at best a limited objective. If profit is given undue importance, a number of problems can arise. Discuss 4 of such problems. So they have given to you one line that for a company, profit maximization is not the sole objective. There are other objectives also. And therefore, if you give too much importance only to profit maximization, then a lot of problems might arise. Discuss 4 such problems. I'll take you to the solution, children. So the first problem that they have discussed is the term profit is vague. It does not clarify what exactly it means. So children, profit means different things to different people. Even time periods are different. Some might be taking short-term profit into consideration, some might take long-term profit into consideration. So profit term is vague. That is one problem, children. Clarity is one of the biggest needs of any vision of any company. If the vision itself is vague, then that itself is a problem. The second issue they have highlighted is profit maximization has to be attempted with the realization of risks involved. Now children, if profit is the only objective, then what the finance manager will say? See, to generate profit I have to take risks, and therefore for maximizing profit I will take more and more risk. But children, risk doesn't always lead to profit, right? Otherwise, where is the risk? Risk can also lead to extreme losses. You might end up being bankrupt also. So children, do you realize if profit is the only goal, you might end up ignoring the risks you are taking for achieving that profit goal, and that might be a big area of concern, right? Point number 3, profit maximization as an objective does not take into account the time pattern of returns. Now children, if I say that okay, I want to go for project A, because this project will give me lot of profit, but it will take around 20 years for that profit to be generated. We will have to wait. Now students, this waiting time period also needs to be taken into consideration, right? It is not only the profit that is getting generated, also the time in which the profit will get generated, that should be taken into consideration. So this is the third issue, the timing factor is ignored. And fourth, profit maximization as an objective is too narrow for a company. Do you realize apart from profits, they have to also think about various other aspects like the society, the government, the employees, you're understanding their corporate social responsibility, ethical trade practices, etc., etc. A lot of things are given here. So children, all these also need to be taken into consideration. You cannot be so narrow that only focus on profit. So these are 4 points that they have highlighted here as far as question 10A is concerned. The next and the last point they're asking you is discuss the agency problem and its cost, how it arises and how it can be addressed. Now children, what is agency problem? What happens is, in a sole proprietary firm, the owner and the manager are the same person, right? In a sole proprietary firm, the owner and the manager is the same person. But when it comes to a public listed company, can I say there is a difference between owners and managers? Managers are the ones who run the day-to-day affairs of the company, and owners are the shareholders who have invested in the company. Now children, in one sense, can you see that those managers are acting as agents of the shareholders, the owners, to run the company, and therefore the objectives of those managers should be aligned with the objectives of the owners, the shareholders, that is to maximize their wealth. If those managers have any other objective, right? If those managers have any other objective different from increasing the wealth of the shareholders, there lies an agency problem. Sometimes, children, do you realize that these managers would take decisions so that their personal salaries or perks, etc., might get magnified, not thinking about the shareholders? That is the agency problem. Everyone clear? So that's what they're saying. Discuss the agency problem and its costs. So children, if you see here, agency problem, they have discussed the entire thing here. You can read it on your own later. And of course, children, as you know that now, if the owners feel that the managers are not aligned with their interests, with the shareholders' interest, with the owner's interest, then they need to incur some additional cost, right? They need to incur additional cost, and that cost, children, is called as the agency cost, which is basically the cost borne by the shareholders to monitor the manager and control their behavior so as to maximize shareholders' wealth. Generally, agency costs are of 4 types: monitoring, bonding, opportunity, structuring. Children, monitoring means, you know what monitoring is. They will monitor the decisions of the managers. Bonding means some exercises need to be taken place to create good bonding between the owners and the managers. Opportunities means, children, the shareholders need to communicate very clearly to the managers regarding the future opportunities, both for the owners as well as managers, and not look at the opportunities from only managers' point of view separately. And therefore we will have to structure the whole thing in a way that these managers' interests are aligned with the shareholders. Then, children, they are asking how it arises and how it can be addressed. Now children, the agency problem arises if managers' interests are not aligned to the interests of the investors. I told you everything about it just now. And children, to address, they are saying following efforts have to be taken. First, managerial compensation is linked to the profit of the company to some extent, and also with the long-term objective. So children, if we can, as owners, ensure that as our wealth increases, manager's wealth also, personal wealth also increases, by linking his compensation to the overall performance or the growth of the company, then they might not do any nefarious activities separately to make their pockets personally rich, right? So they are saying managerial compensation is linked to the profit of the company. Second, employees are also designed to address the issue with the underlying assumption that maximization of the stock price is the objective of the investors. So basically, the hiring process also has to be such that whoever you are hiring has to be made it very clear that your goal is not to make yourself rich. Your goal is to maximize the share price and therefore make the investors rich, and in due course of time, of course, you also personally will get rich. Point number 3, effective monitoring has to be done, right? So children, these are the 3 courses of action that we can take to address the agency issue. So this was point number B. Children, here they have given some different examples, okay, about the agency problem. You can read it on your own, right? So with that, we complete the discussion to question 10B, and with that we complete the discussion to this entire RTP of May 2022 CA Inter Paper 8A Financial Management. I hope this was of help to you. From me here at JK Shah Classes, we wish you all the best for your exams. Take care and study well. Bye-bye.